What's up everyone, it's Caddy with MoneyVest. So in this video, we are going to be talking about 3 ETFs that I've got for you to consider. It's going to be for different types of investors, which is exactly why 2 of them are going to be fixed income ETFs. These are fixed income meaning bonds, and the other one's going to be equities. But the focus here is going to be on dividends, right? So dividends, basically every single month, every single quarter, depending on the payout structure, you're going to receive passive income, which is dividends received through these ETFs. That 2 of them are going to be in fixed income. One of them is going to be in the equity sector, but they've got very special sort of unique way of obviously being structured. So I'm going to go over that in this video. These are not REITs. We're not going over real estate investment trust. These are not stocks, dividend stocks. We're not going over dividend stocks. We're going over ETFs that are constructed with bonds and stocks in them. And of course, that do pay out pretty reasonable dividend yields in case you are not interested in treasuries, right? US treasuries, which obviously are giving you 4.5%, closer to 5%. So hope you guys enjoy this video and find it helpful. I have looked through a lot of different ones, and of course I finalized 3 over here that are on my notepad here. Again, make sure that you drop a like, subscribe to the channel. Link to our Discord and Patreon is going to be down below if you're interested in joining our MoneyVest community. There is a 16% annual discount that's available till the end of this month, so 5 more days left if you want to take advantage of that as well. Link's going to be down below. So first, we're going to go over this very simple credit rating scale structure, right? These are by a lot of different agencies. So we know Moody's, we know S&P, we know Fitch. A lot of them basically tier all these companies based on their credit rating, right? Credit rating is basically how you have a credit rating, right? So you've got a credit score that basically tells lenders and other banks what is your ability to pay, right? If you've got a really high credit score, that means you are a very disciplined borrower, you pay your bills, and you can be trusted with lending money too. Similarly, if you have somebody else that has a very lower credit score, that means they are not the best borrower in the world. They've got a lower credit ability to repay back that loan. The default rate's going to be higher, so on and so forth. And that's why, again, when it comes to the rates, interest rates, and the terms, a high credit worthy borrower is going to have the best terms. It's going to have the best preferences, the lowest rates, versus somebody who has a lower credit score. They're going to have the worst terms, worst rates, worst possible interest rate. And that's the same thing with companies as well, right? So the companies that have the best credit ratings are considered to be like high grade, or in other words, investment grade. And that basically are going to be AAAs and AAs and AA plus. Even triple Bs are considered lower medium grade, but they kind of do fit under the prime category of, companies that do have pretty good credit ratings. Anything that's non-investment grade is going to be double Bs or lower and highly speculative. That basically companies that carry, a very significant amount of default risk. Maybe their balance sheet's not that great. Anything that's, below double B also considered as junk or non-investment grade. So I'm going to bring up an ETF that's going to fall in these upper half of investment grade of corporate bonds that pays a very good dividend yield. And I'm going to bring over an ETF that maybe not so much the investment grade, but it is a high yield corporate bond ETF that sits underneath this sort of area. The credit ratings may not be as great, but it's a very high yielding dividend ETF. And then I'm also going to go over an ETF that is going to be equities only. So it doesn't have fixed income, doesn't have bonds, doesn't have corporate bonds, but it's got equities. And of course, it still pays a very reasonable dividend. So first, let's go over to the equity ETF, because that's going to be a lot more easier for us to understand and analyze, and that is going to be VYM. Now, this is a ETF. This is offered by Vanguard High Dividend Yield ETF. And we've talked about this before on the channel, but anybody who's interested in having that sort of mix of both growth and dividends, VYM is one to consider. Vanguard is a very trustworthy, very reputed issuer, and they've got $49 billion in assets under management, started in 2006, open-ended fund. If you come down to the holdings, the number of holdings, it is mostly focused on the United States, so North America and the US. 99% of assets are in the US, and some of the companies that you already know, right? These are all companies that are paying very good dividend yield. They are more value-oriented as well, But again, it's a good mix of both value and growth. So 3.3% in ExxonMobil, JP Morgan, we got Johnson & Johnson, we got Broadcom, Procter & Gamble, Home Depot, Chevron, Merck, AbbVie, Pepsi, Walmart. I mean, the list goes on and on, right? We got Bank of America in here, we got Caterpillar, Amgen, we got Nextera Energy, Union Pacific, Starbucks, Gilead Sciences, Citigroup. The list goes on, but these are all U.S. companies, blue chip companies, Waste Management. A lot of them are well established. Many of them are profitable to significant extent. And this is the breakdown of the sectors. Finance, 19%. Then we've got, I don't know what happened. So finance, we got 19%. Technology, we've got 12%. Just electric technology, 10.6%. Non-durables, consumer items, 11.4%. It's just a very good diversified 463 holdings. And if you come over to the overall pattern for VIM, you'll notice that it's been on a consistent uptrend. So if you go over to the monthly chart, you see nothing but a very nice, move to the upside, very similar to what you would see for the S&P 500. Since 2009, this is up a little bit over 670%, and right now pays out a dividend yield of over 3.2%, which actually is pretty good in my opinion, considering all the companies that are in this index or in this ETF pay out a very good dividend as well. So it's an aggregate of all those dividends received, and 3.2% is going to be that number. One more thing I want to point out is because it's more diversified, it's a little bit more value focused as opposed to the S&P 500 and the NASDAQ, which are very much weighted towards technology. It didn't really have that much of a sell-off, right? So this right here, you'll notice that since 2022, it basically only dropped by about 15%, right? Think about that for a second. NASDAQ, which was down over 30% plus, S&P, which was down over 25%, this one was only down 15%. So you're getting a lot less volatility for considerable amount of upside with respect to both growth in the price itself and the dividend yield that you're collecting along the way at a little bit over 3.2%. So this is one that I would personally be considering as a dividend ETF, right? So Vanguard High Dividend Yield ETF, VIM, something that definitely does offer, pretty good diversification, pretty good, solid companies that are established, and also that lower volatility, a lower beta, and of course that higher potential for dividends and the growth that it offers. So that's going to be the first one. Next one on the list, now we're going to jump over to fixed income, okay? So this one that I just went over, this is equity ETF, right? So this ETF basically has equities or stocks in them. The next two that we're going to go over are going to be fixed income, and that's going to be corporate bonds. Corporate bonds are very simple. They are bonds issued by companies and investors buy them, right? So in other words, investors are lending their money to these corporations, and in return, they're getting a rate of return. They're getting a coupon in return for lending this money to corporations. It's very similar to U.S. government, but in this case, we're doing it to corporations. And this is where this grid basically comes into play, because if you are higher on this scale, if you are investment grade, the return is going to be lower, right? That rate of return is going to be lower because, like I said earlier, the best credit-worthy borrowers have the best terms so they can get that financing at a lower rate, versus companies that are not very great or borrowers that are not very great in terms of their credit. They're going to get the most unfavorable terms, so the rate's going to be much higher. So as an investor, if you are looking at investing in, let's say, junk bonds have the highest risk, but they also have the highest rate of return, whereas investment grade will have the lowest risk, but also the lowest return on this scale. So first, we're going to go over to investment grade, and that is going to be LQD. This is an ETF that's been on my watch list for quite some time. It's issued by BlackRock. So this is going to be the iShares iBox USD investment grade corporate bond ETF. The volume is pretty solid, so BlackRock is the issuer. Expense ratio is also low at only 14 basis points. We got just under $32 billion in assets under management. Started in 2002, open-ended fund, and the main focus here, once again, is going to be North America and all the US companies, right? So this is corporate fixed income. So the previous one that I showed you guys was on, so if you come over to VIM, if you come over to asset class, it was going to be equity. So let's just come down here. There we go. Asset class was equities, right? Over here, and this over here is fixed income. That's why it's constructed using corporate bonds. If you come down here, 86% is in the US, and these are once again some of the most well-established, well-known companies that you already know. And you can see the rate that these companies are paying on their corporate bonds and the maturity of their bonds. So for example, CVS Health, 5% rate of return expiring or maturing in 2048. So these are very, very long duration corporate bonds. We're talking 15 to 20 years. If you come down, you're probably going to see a lot of other companies like JP Morgan, for example, 5.35% maturing 2034. If you come down, Bank of America, 5.288% 2034. There's going to be some tech companies as well. So for example, Apple right here, right? 4.65% February 2046. That's going to be Apple over there. Then we've got Amgen, 5.15% expiring or maturing in 2028. I'm sure you can find Microsoft and Meta and all these companies here as well somewhere. Here we go. Amazon's in there. So Amazon, a little bit over 4%, maturing in 2047. So what you'll notice is the rate, that's the coupon rate, plus the maturity of that corporate bond. So if I come down, I'm sure I can look up Microsoft as well here. Yeah, I don't know what's going on with this stupid website. Okay, I just got to reload this page. ETF.com needs to fix all these lags. Anyway, so this right here is, once again, going to be LQD's holdings, but you get the idea, right? These are all well-established companies. Let's see if we can look up. There we go. Microsoft, 2.92%, so better financing than Apple, maturing in 2052. It's a very, very long duration bond, like 2052 minus 2023. We're looking at 30-year bond, right, on this. Microsoft, this one's 2050, 2.5%. If you type in Meta, Meta's also in there, 3.85%. This one's maturing in 2032. So if I come over to LQD now, you'll notice that it's actually underperformed because it's fixed income and bonds have underperformed significantly compared to equity. So that's why it's not the same chart as VYM. VYM's done really well, but the dividend yield on this is a little bit over 4%. Now, 4% versus 3.2% is not that significant of a difference, right? So again, if you are more concerned with, 4% versus 3.2%, but with 3.2%, you're getting a little bit of that growth aspect to it, and it's an equity fund, then again, you have to do that analysis yourself and kind of figure out, okay, what's better suited as a dividend ETF for your portfolio. But this is something that can also be considered as an investment grade corporate bond fixed income ETF paying you 4% dividend. And yes, it has underperformed more recently, so it hasn't really recovered since September 21. It was down over 26%, very similar to the S&P 500, but now it's just trading sideways at the moment. But overall, you'll notice that it's still done really well. Since 2000, it is up over 144%. So not that much, right? Nothing compared to an equity fund, because equities have obviously outperformed fixed income and bonds. But for the right investors, this could be a potential place where you can consider parking cash and generating that 4% dividend yield at the moment, knowing well enough that, okay, there's very well established companies that are issuing all these bonds on a corporate side. And last but not least, I've got one more, which is going to be on the higher scale when it comes to interest rate, but of course carries higher risk as well. So that's going to be HYG, and that is going to be your high yield corporate bond ETF. So it's not going to be investment grade, but the focus here is on high yield. And if you come down here, again, issued by BlackRock, it's a little bit higher expense ratio of 49 basis points, $14.6 billion in assets under management, open-ended fund. Again, 82% is going to be in the US, 1,184 companies. So it's a lot more diversified, but at the same time, these are companies that, these are not that best in terms of their credit ratings. Yeah, see, I don't know what the heck is going on with this website. It just keeps crashing on me for some reason. Anyway, so once again, we are back to this holdings page. And then over here, you'll notice Dish Networks, 11.75% maturing in 2027, right? We got Cloud Software Group, 9% maturing in 2029. We've got American Airlines here, just a little bit under 6%. We got American Airlines again at 11.75%. So you can kind of start to see the difference of these financing, right? Investment grade was obviously a lot lower in terms of interest rates versus these types of bonds, corporate bonds that are paying you very, very high interest rate, but at the same time, the risk is also high, right? American Airlines is heavily indebted. Dish Networks is heavily indebted. If you come down, I'm sure you can find a lot more companies that you've heard of. A lot of them I personally haven't. Caesars Entertainment, for example, is 7%, 2030. Vodafone, so this is going to be in the UK. A little bit global fixed floating rate here. But you get the idea. And the dividend yield on this HYG is going to be a little bit over 6%, I think. 5.8, so almost 6% is that dividend yield on this ETF that has high yield corporate bond fixed income products. So 5.8%. So we've got 3.2, 4, and then 5.8. Now 5.8 is definitely a very, very high interest rate on a yearly basis. That's almost comparable to what the S&P 500 pretty much averages every single year, right, on a long-term basis. And even then, of course, HYG has seen a little bit of that rally back up, 12, 13%. So it does have a little bit of that growth component. And surprisingly, lower volatility. I mean, it was only down 16% from its highs of well over $80, only dropped down to $66, and the volume's pretty decent as well, 31 million shares traded every single day. So surprisingly, the volatility is good. And I think the reason for that is because it's a lot more diversified. It's got 1,100 stocks, right? And they're also spread across multiple different countries, even though 82% is in the US. But, it is more diversified compared to the S&P or the NASDAQ, right? It's not very much focused on tech. And that could be one of the reasons why it's down was only down 16% from its highs back in 2022. But there you go. These are the 3 ETFs. So VYM obviously is going to be the equity ETF with a high dividend yield of over 3.2%. Has that both mix of both growth and dividends. Then we got LQD, which is more towards the fixed income bond ETF, which is investment grade corporate bonds, pays you a little bit over 4% dividend, but doesn't have that growth aspect, and of course is volatile. And then we got HYG, which is going to be high yield corporate bond, surprisingly a lot less volatile, but pays a little bit over 5.8% in dividends, but of course does have lower credit rating companies. That's why the rates are so high. So let me know in the comment section down below if anything kind of piques your interest. Hopefully this was a little bit of a help in, again, a different type of investors, focusing mostly on dividend yield. So these are the 3 different ETFs. Let me know in the comment section down below which one's your favorite. As always, if there's any other ones, also let us know down in the comment section below for fixed income and corporate bond ETFs that you might be interested in. But as always, happy investing, and make sure that you do check out the links down below for our Discord, for our Patreon, and we'd love to have you on board. There is a 16% annual discount available till the end of this month. And as always, happy investing. I'll see you all in the next video.